Hi, Darin Mangum here, the PPM Attorney. Today I wanted to talk about an issue that comes up sometimes when especially when you're setting up like uh, a real estate private placement offering memorandum or real estate fund. Um, again, usually it's a project-based type real estate fund, um, and that is the difference between a capital interest and a profits interest when it comes to the interest of the managing member or either a general partner or the managing member, whoever is usually the promoter that's putting together the deal has a profit, again, either a capital interest or profits interest, or a carried interest. I mean, there's a lot of ways to structure that. Um, and again, I'm not a tax lawyer. I don't we're purely I'm just purely a securities lawyer, but it definitely can have tax implications as to how you structure things from the beginning. Usually the way these deals are set up is you've got the promoter or the managing member or the manager. Again, lots of different terms could be used, but they get basically a profits interest in the deal, and then the investors get an interest as well, right? And so you've got two different classes of equity in the deal, usually how that's structured. And so it's important, especially it depends if, well, let's say there's a piece of property that is coming into the project, and let's say um, you know the investor's capital comes into the deal, and then they close on this asset. So let's say it's a hotel project, and they're acquiring this hotel. Well, if the manager, or the managing member, or the general partner, if they're receiving, let's say, like a typical deal would be like an 80-20 split. The general partner or the managing member gets 20% and the investors get 80. I mean, that's just one way to do it. And Or, for example, it could be a 50-50 split after the investors get a certain preferred return. I mean, it could be lots of different ways to structure that, but if the managing member receives that interest as sort of as compensation or as an interest in the project, and it has actual value, right? Then they could potentially be taxed on that value that they receive, even though there may not be any cash in their pocket because of the value of that asset. Let's say it's $1 million property, and they basically get 20%. It's like, I just got $200,000 of income or interest in value, right? And guess what? I'm probably have to pay tax on that. Whereas if it's structured in a way that, oh, hey, maybe the managing member doesn't, maybe they receive a future profits interest if the property is later sold, and they only receive it at that time, then obviously that could be, it could be a big deal, especially if, let's say, the real estate investment fund is going to hold on to that asset for, let's say, 3 or 5 years. I mean, the general manager, you don't want to all of a sudden have a tax bill year one on that value, because you don't know if it's going to be profitable or not. You got to pay a big tax on that interest. But whereas if it's structured more as a profits interest, that, hey, let's say they're going to manage the property, and the idea is that the project is later going to be sold, or maybe there's income that's going to be derived from it for a little while, and then it's sold at a future profit. Then certainly in that case, it's all subject to, right? It's not you're not receiving that income right up front. You're receiving it in the future, and which is great. That's kind of why you put together the deal in the first place. But in the latter example, it could, because it's considered a profits interest, and the interest doesn't really vest until the property's sold, or let's say the interest doesn't vest until the investors get their capital back. Some sort of combination, like some sort of language like that in the operating agreement is very critical to make sure that you're not incurring some sort of tax bill. But again, this is not tax advice or obviously legal advice to anyone. This is just general principles that you need to think about when you meet with your CPA and or your tax attorney. As far as when these deals are structured, just to make sure that it always helps to have them take a look and make sure it's being the language is structured right, the way you need it to be. So anyway, just some issue, an issue that we've seen come up from time to time that people may not be aware of, but it's important. So anyway, hopefully this content's helpful. If so, feel free to like or subscribe or leave a comment in the comment section below. Anyway, and if we can help you with your private placement memorandum or PPM, feel free to reach out. I'm glad to help you. Darin Mangum. Feel free to give me a call on my cell, 801-787-9072, and be glad to take your call or your email. So anyway, hope to talk to you soon, or see you in the next video. Thanks.